Good morning. My name is Elsa-Sofia Morote, Dr. Morote, and I will be talking about venture capital, equity, and ways that an entrepreneur can can get finances. So to begin that, I found very fun PowerPoint because I will post this in YouTube. So I wanted to give background for some people who will look at this before talking about research articles and things like that. I found this PowerPoint who says venture capital for fifth grader. This PowerPoint explains very easily what it is. So a person creates a product or a service that they want to produce and mass produce it. That person will call it entrepreneur. That entrepreneur obviously need money to grow. So that you will find a venture capitalist, a person who is willing to invest in that product or service because he sees a future that eventually he will get some rewards of that. So the person explain, the entrepreneur will explain the virtual venture capitalist what the person needs and why they believe this is a good area to invest. So once the person present the idea, they say, okay, you know what, I will give you the money and this is how much I want from your company. It's kind of the Shark Tank, so those Shark Tanks really are venture capitalists. The idea of doing that is you will see that place grow enough to start making money, but the venture capitalist is always thinking about how to make money. So at some point, he will introduce somebody to help, and eventually that, like for example, a Ben and Jerry, eventually that will buy the company, and then everybody will get some benefit. So that venture capital is in between the company of that. So that's the basic concept of what is a venture capitalist. But now let's talk about something more, I would say more academic of what it is. So how venture capital industry works. So I found this information inside there 1998. He explained, I mean, it's a 1988, but it's so good. The explanation was so good, so I want to use it. That how the venture capital industry works is the venture capital industry has four major players. Okay, so in the small PowerPoint we explain only two, but it's really four. We have the entrepreneurs who need funding, the investors who want high returns, the bankers, we need to talk about the bankers, but the bankers are part of this, the bankers who need companies to sell, and the venture capitalists who make money themselves by making the market for the other three. So the venture market is that center from that. So as you see in this picture, we have the entrepreneurs. Sometimes they receive money from governments or corporations, and they start trying to create a product or service, have ideas. They go and will connect with the venture capitalists, which explain the idea, and they will try to make some money. After they do that, the venture capital probably get money for private investors or other kind of investors, okay? And eventually what they will do is they will require the invested markets, because once this product or company start growing enough, they really want to sell it. So one of the things that they want to do is make money. So basically that is a venture capitalist. So something is important to understand is in 2020, for example, the New Business Daily warns the entrepreneurs that they may, I mean, what happened if the startup fail? They say, well, the interesting thing is, as an owner, you are not obligated to return the money. However, you will lose control. So the venture capital will take control of your company as well as anything that you have invested in that company. So that is interesting. So Bob Snyder in 1998 explained that it's not really a long-term money, because the venture capitalists, they're looking to help you to reach until you reach a size and take the money in order to make money. The interesting part, so that is the venture capitalist. Now, we have another concept that we discussed, which is corporate ventures capitalists, which is a little difference about that. For that, to understand the corporate venture capitalists, we need to think about the difference between those. And let me just share my screen with a nice site that I found that explain that. So the corporate venture capital, here it is really a corporate who provide the fund to the startups, and they manage this as a portfolios. Okay, they manage this as a portfolio. The venture capital, they connect money from different areas, could be business angels, institutional funds, or corporates, and there will be a fund and they see. Now, there is a big difference between one and another, because usually the venture capital, they're really looking for a fast, for a movement on that. The corporate capital, they manage this as a portfolio as well. The interesting part of comparing these two is as an entrepreneur, you will need to decide which one you want to utilize. So you need to evaluate your options, right? Your options about which one you want to do it. There is a study made by Gutan, Smeich, and Stuber in 2019, so that was just last year, right now in 2020, that he did a qualitative study, and then he evaluated 26 corporate venture capitals. They reveal a comprehensive set of value creation, and they capture how the services they provide to their units. Okay, and in those 26, we have different kinds of corporate venture capitals. Could be conglomerates, automobiles, telecommunication, and media. And here's a table I found was presented by Gutan, Smeich, and Stuber, which really gives a picture of what is the difference between corporate capital and corporate venture capital and obvious venture capitalists. So the corporate venture capitalists, they really participate more on the industry. So they can have the participation is divided in 3 sections: as a core, as a supporting, as a reputation. So for example, as a core, they can participate in the business. They want to focus strategic, focus on that. In the operations, they analyze the marketing, the products, and all of these services. For example, this one person say, we can use all research and industry expertise to scale up. So they help them to really scale up and start running the production and scale. And we can see that when you saw that I am very fans of watching Shark Tank. So I actually see sometimes they actually go further, because it's not only giving them the money, but also they also give me some services in order to improve and I think that's what the people value of that. So the technology also, they can support, develop, and optimize markets. Also there's a legal support, recruiting, helping qualify people to be part of that capital. And we saw in several organizations who actually do that. They move it a qualified person who can move that and improve the company. Infrastructure, sometimes you have agreement with others and maybe facilitate that low cost. Of course, the reputation is very important as well. So doing that, we need to think about, as an entrepreneur, we need to think, if we will try to do one or another, or maybe both of them. Something that is important to me, when we word the word venture, that means risk. So they undertaking a risk. And when we do capital, is really meaning other money. Venture capital means that funds made available for startup firms and small businesses with exceptional growth potential. You really have to have that growth potential. Venture capital is the financial support to young, rapidly growing companies, individuals that have potential to develop into significant economic contributions by the business main woman. to create that product and service as a unique idea. So most of the people think about venture capital in product, but could be a service as well. What is the features of a venture capital? It's high risk. There is a participation in its management. So if you receive money for a venture capitalist, that you will expect that there will be a participation. They usually participate at the early stage. They try to finance smaller companies, less mature companies. They're really looking for something new and fresh. And of course, they're looking for rapidly growing. And the entrepreneur don't have the liquidity, so that's the reason they contact them. Also, why we need venture capital is because they have the ability to maximize the utilization of available resources. The advantage is it's advantage for the investors, advantage for the economy, and advantage also for the entrepreneur. And that's very important for us. You know, as a future entrepreneurs, we want to make sure who is taking advantage for this. Another thing that part of the studies explain the difference between traditional investor or venture capital investors. And we ask sometimes, okay, so why we don't go to a traditional investor instead of going to the venture capital? Well, there's a difference. Traditional investors are looking for a steady and constant return and not involved in the company decision making. So people can give you the money and you will be some extra money. And they're really looking for a consistent, steady. But the role of the venture capital investor is powerful because they're really external stakeholders who positively moderate the slack on performance relationship. For example, Banneker in 2013 found that the presence of venture capital investors positively moderates the relationship between the both financial and human slack resources and performance. So venture capital investors invest in a large portfolio of firms. So they have several companies they're serving. This is important because the individuals are better able to assimilate and exploit knowledge when they have previously accumulated experience within large knowledge of domains. And that was another study by De Klerk and Dimon in 2008. Banneker in 2013 tested several hypotheses about venture capital investors, in which two were relevant for trying to figure out the difference between traditional and venture capital. The first hypothesis that was positive is the impact of financial slack, so meaning on user resources, and human resources slack on firm performance were positive when the venture capitals participate. It's very interesting because they know that they already have experience, so they can go and see the sections that need to be improved and they're misused. Also, it shows that that impact is really increase the performance in a positive way. Another thing that's interesting is about the information that we receive from the different resources that we receive and how this venture capital is a type of early stage of investment that provides money to the firms to get started. That means that we go from A to B, and that helps the new entrepreneur or the entrepreneur to actually go further and create this company. There is a lot of several cases that we learn in this case. So with that, I think we have a better picture of what venture capital is, private company, and also something that we call private investors. Another thing I would like to speak is about the types of fundings that we receive, the entrepreneur can receive. So we can have seeding capital, startup capital, early stage capital, expansion capital, and last stage capital. So depending where you are, you will receive different kind of fundings. And that also varies the risk and the research development. And that will vary also the amount of money that you will receive and the venture capital you will capture. A venture capital is a person or investing firm that makes venture investments, and these venture capitalists are expected to bring managerial and technical expertise, as well the capital to their investments. So it's not just giving you the money, but also they bring something on the table. The characteristics that you will look for a venture capital, you will look for, will be well managerial skills, well knowledgeable, sophisticated investors, decision-making ability, analyzing skills, and technology background. So you will find that person when you're looking for. The services that generally provided by the venture capitalists, we have, for example, finance. They can help you to purchase equity or securities. They assist in the development of new products or services, and they add the value through active participation. How do you get this funding? There is 4 steps. The first step is you submit a business plan. You engage with venture capitalists in a conversation, in a meeting, and then you start discussing about the actual funding. The venture capital will analyze we see the predictions, and then you can have a conditional loan, equity, quasi-equity, participation in the venture. So you will have different kinds of ways to participate on this. Now, a venture capital fund refers to a pool investment vehicle that primarily invests in the financial capital of the third-party investors. And that's important because we need to figure out what to do. Now, the important thing, there is eligibility. So if you want to be part of receive money for a venture capital, there is eligibility, will be a company, a trust, body. So there will be several regulations, but that will be part of another kind of presentation. So this is important I focus most of this presentation as an entrepreneur point of view. And when you search in the articles, they discuss a lot about the advantage of having venture capital. But let's discuss about disadvantage, because there is also disadvantage. The process could be a lengthy and complex process. You need a detailed business plan, a financial projections, etc. And there is a negotiation stage, so you will have to pay for legal and accounting fees. And investors become part of owners of your business, so you can lose some authority or control. So the problems that you may face by venture capitalists is you really have to have an experienced management team. You need to have your return have to be above the average. There will be a longer payback period. And there will be questions about the infrastructure, the production. And so there's a time period that this will be mature on this. So, but besides the disadvantage, of course, there is an advantage, and I want to highlight before I finish the advantage. They will have provide large sums of equity finance, so you will have the money to do it. The venture capitalists are rewarded by business success and capital gain, so they're looking for you to be successful because your success is their success. They're able to bring wealth and expertise of the company. They have a lot of connections. That connection will help them to actually figure out how to help you better. That network of contacts is amazing. It's important. And of course, they can also, if they see the importance of the business and it's growing, they will also invest more. So what is the features of all of this relationship? We will have a long-term investment. It's a high-risk return. You will receive a private equity, and there will be an equity participation. So that is related to venture capitalism. Thank you very much. Thank you for listening to me.